We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Tavi Costa, Portfolio Manager at Crescat Capital. Tavi, how are you today?
I'm great. How are you, Tom?
I'm excellent. It's great to have you back. And, this seems like the perfect time to really be able to have a conversation with somebody that has been really looking at the gold industry quite heavily and let's say the commodity space more generally. I'd like to base today's conversation around all of that, but I think a good place to start right now is by trying to understand, let's say, this turning point that we're at in the overall markets right now. How do you foresee the markets reacting to the rate cuts? It seems like this week the Treasury market is signaling distrust in the possibility of the Fed's target of a soft landing.
My view is it's looking at the data itself. It's very difficult to justify a rate cut. And, you can maybe claim that labor markets have started to show some cracks and therefore, markets should be showing some issues, but markets are all-time highs. It's a leading indicator for the economy. And so I don't think the message is really there. My view is that the Fed has really shown their cards when it comes to the limitations that they have to deal with the rising, or I should say surging, interest rate payment relative to GDP that the government is facing. And so when you think about the Fed policies sort of morphing into this, tool to allow the government to lower their burden on servicing the debt. And so it's this whole mandate that we keep hearing and talking about is becoming less and less relevant in this environment. And my research shows that if this is the case, I think that the Fed, especially when you look at across the globe with interest payments relative to GDP, are substantially lower of most economies elsewhere outside of the US. And I think that will cause the Fed to actually have to act with a sense of urgency that is not shared with those other economies. And on a relative basis, that has to have an impact on the currency side. So I remember talking to you, Tom, about concerns of the Treasury market back in 2021.
Mm-hmm.
I am sharing the same level of conviction and concern regarding the dollar, not only relative to hard assets, as I've always very consistently had a view on, but now it's starting to have a view versus other fiat currencies. I think that has been a very contrarian opinion, given the fact that not a lot of people are willing to buy the euro, the Japanese yen, the Canadian dollar, the Australian dollar, all sorts of reasons of why you shouldn't do that. But I think this time, especially the ones that have very rich resource driven economies, are going to be more favorable in this next 1 to 3 years. Given this environment of sense of urgency of the Fed having to act quicker than other central banks. And this is going to be a big change in a lot of things: inflation, gold, emerging market stocks, currencies, needless to say. And so, yeah, this is sort of a big deal.
Absolutely, Tavi. It really seems like we're on, let's say, the precipice of a big change, like a step change in how many of these currencies and markets and countries are valued and let's say going forward revalued. So just to put that a little bit more succinctly, do you think that the US dollar is likely entering more of a structural bear market because of the cost of serving this overall government debt, and that is more than likely what the Fed is reacting to?
I think structure implies, 5 to 10 years, and I think it's possible. I'm trying to use my macro hat and not a pessimistic doom and gloom hat of saying that this is the end of the dollar. That's certainly not what I'm trying to accomplish in this interview.
Mm-hmm.
But I do think that it's as a macro investor, um, the dollar looks extremely weak for the next 3 years. It's going to be policy dependent
Mhm.
to have a structural view, but I think it's very possible. Asking the question as of today, I would say that I would give a very high probability that the dollar could enter a structural bear market over the next 5 to 10 years,
Mhm.
given of all the things I said. And this is an important aspect because we've been basically borrowing money from the future by spending as much as we have been spending. I've done a research looking at the average fiscal stimulus since the global financial crisis, and the US alone has done close to 8% of GDP. 8% of GDP every year since the global financial crisis in average. The closest to that would be Japan, and Japan spent close to 5%. Now, there's a catch to this. Majority of that spending from Japan is actually entitlement spending. In the US, while it is a significant portion, it's not as large as Japan. And so you have to understand what is a pro-growth spending. That's the next question. In some emerging markets, that's a discussion that has been the case and has been, talked about for many decades, which is called the primary deficit. It's understanding what is your spending when you reduce or when you exclude interest payments, which are not it's a very non-growth, non-productive type of spending. And I believe that when you look at the US and the spending we've seen since the global financial crisis was actually the most pro-growth you could find. The entitlement spending, while it's a problem and it will become a problem even further over the years,
Mhm.
has been actually relative to GDP somewhat stable. What has not been stable recently has been the interest payments. That has surged because of the hiking of interest rates. And that is unsustainable. Now, right now, just to give you some sense, about 55% of the fiscal spending, 55% is going to non-growth. It's going to entitlements, it's going to interest payments. All these things do not generate growth. I would argue that one of the main reasons, and these things happen throughout history, right? We have a period of 10 years where emerging markets lead the way to the upside, resource commodities lead the way to the upside. You have emerging market currencies leading the way to the upside. And then you have other periods where, technology goes up and you have potentially the US companies doing better. So these, the valuation differential between US versus the rest of the world, to be simplistic, is not a linear, sort of trend. It's somewhat extremely cyclical throughout history.
Mhm.
And I would suspect that we're close to a pivotal moment in that, and that we've seen that extreme already played out in the last 10 years, which I think that one of the biggest contributors to that differential of a US company being so expensive versus an emerging market company, for instance, or any other company outside of the US, is because the US holds this profile of having the reserve currency status that allows them to actually have a much less disciplinary approach and spend more than other economies. Now, that's a taking bomb, but you can't really do this forever. Otherwise, you start hurting your currency. So it's interesting that we're seeing, think about the developments, COVID happens, we have this crazy amount of stimulus, and finally you start seeing some lack of strength on the treasury market. Treasury markets have one of the worst years that we've seen in the history of that instrument. You start losing, a lot of momentum there. And then you start seeing central banks accumulating gold right after that. And now are in a position where the dollar actually performed very well in that environment. So it's been kind of hitting, and something that I think a lot of people have said before, which is the dollar is the dirtiest, is the cleanest of all the dirty shirts out there.
Mhm.
That became sort of a prominent view in the markets. While I used to agree with that opinion, you have to change your views when the facts change. And the fact right now is that the US have one of the worst imbalances of interest payments to GDP than any other economy. Yes, debt is a problem. When you look at the debt imbalance is an issue, But when you're running a country or a company or any business, you have to pay your every quarter what is due. And so if you're not able to do that, you have to issue more.
Mhm.
And the US is in a position right now that I think they either have to suppress interest rates and justify that either by looking at labor markets or I don't know what it is, or claiming they won on inflation, which I don't think it's the case, but some people have been using that as an argument, or they have to spend even more. And so those two items or could actually happen together. They're combined. They're extremely inflationary. So you have to kind of operate from that, kind of that perspective when you're investing, in my view. And so it's hard not to be, just muting everything else and focusing on hard assets because I
Mhm.
think that ultimately that's what drives this entire market.
You mentioned the labor markets there, Tavi. Do you think the reality and once you dissect this last jobs number that we got at the end of last week, is that really showing the weakness in the labor markets and possibly signaling a bigger recessionary type of reaction at this point?
In normal cycles, you would look at the unemployment rate rising as much as it did, and you look at historically, you would immediately say, this is it. We're going to a recession.
Mhm.
Labor markets, have been trending into a deterioration process that it usually never stops there. It's kind of builds on itself and becomes a problem very quickly. But in this environment, you have to watch the labor markets data a little more closely. And I mean this because of the immigration problem. You know, the amount of people that have entered the labor market is quite significant, and so you would expect that that would have an impact on labor data as well. So, if you look at labor force, right, labor force has been stagnant, but labor force would only account for legal workers. So if people are illegally coming here, that measurement just becomes completely irrelevant. But if you look at the unemployment rate has begun to rise. And so what that means, in my opinion, is that illegal immigrants are starting to take jobs from legal folks here in the US. And so this could create social unrest. This could create, protests and all sorts of problems. And so, yeah, I think that overall this is an issue. Now, is this the same clear signal we tend to see prior to recessions? You got to take that with the caveat as well of the labor force increasing. And when I say labor force, I'm including illegal and legal folks in the U.S. So I am, I have a little bit of more caution to understand what the labor, but we have to understand policy making in this kind of scenario, and policy making can be used as using this type of data that potentially to prove their thesis that yeah, maybe we should be a little more cautious with labor markets. And look, this data, this last month unemployment rate declined a bit, and it's not enough to create a trend, right? So we're still seeing those cracks, supposedly. If you're just forget about everything is said about immigration, if you're just looking at the data that way, you know, you can make the case that this is quite concerning, and the trend is worsening. And I think the Fed is going to play that card. And I don't know if it's 25 basis points, 50 basis points of a rate cut, but I do have a view that this trend of cutting interest rates will take place more and more. And if that's the case, if you think we're going to be suppressing short-term rates and in a moment where look at the break evens, inflation expectation and the markets have gone straight up since we decided to cut interest rates. And the interesting aspect of this, if you just look at markets themselves, this is the loosest financial conditions we've seen in the last 2 years. So you can't justify the problem here by looking at markets this with the same lens as we did in the past. So this is all to say that I think the Fed will take any justification they can to cut interest rates moving forward. I think there is risk on the long end of the curve. So the steepening of the yield curve becomes a very interesting investment idea that I've been not only positioned, but also have a strong view on. I think in the next 12 months, we'll see a very strong steepening of the yield curve, particularly 2 versus 10s and 2 versus 30s. And yeah, that will have also implications in markets.
Mhm. Tavi, you brought up this idea of the rise in inflation expectations and, in a way, commodity prices, just as the Fed is starting to cut rates here. So what does that mean for inflation moving forward, and kind of as a, or can we look at it as a proxy in commodity prices as well?
So to give some context to your question, since the Fed decided to cut rates, a lot of commodities have started to jump, and some of them started to move prior to that. If you look at the equal weighted commodities index, it had its largest surging prices on a 4-week rolling change that we've seen since the Russian invasion. And the Russian invasion caused things to surge at that time because we didn't know how things were going to develop. So markets immediately priced everything much higher in the commodity space. But that gives you some perspective that we're not seeing that level of geopolitical or, any kind of, yeah, we've seen some changes recently, but not to the same degree that we saw back then. So what is causing this, rate of change to accelerate again is, in my view, related to what you just mentioned, which is loosening further monetary conditions by reducing rates in a economy that I keep arguing that is, highly entrenched on the inflation side. And, I've been trying to operate my brain and my mindset that I do think that inflation is here to stay. Now, it's going to be ups and downs, and nobody knows what the rate of change will be next month and the following year. But in my view, it's going to be higher than historical standards, knowing that central banks are so limited in what they can do to fight consumer prices rising. And coming from an emerging market, what I do understand is that you either fight that tooth and nail, or things continue to infiltrate the system in a big way. You start seeing protests, and, commodity prices start to rotate. And that's when you have a cycle where, lumber prices surge and then fall, and then natural gas surges and then falls, and then it's orange juice, and then it's sugar, and then it's ammonia prices, and then goes back to copper. Copper becomes the flavor of the day, and then turns into gold, and then silver. These are not unique events. They're all kind of linked. And, we didn't see that in 2013. We didn't see that in 2014. We didn't see that in 2015 because we're not in a commodity cycle. So I think that these are very important changes. And how do you fix the commodity issue? It's not just by letting prices go up a lot that hurts demand. That's not the explanation of this. While that causes the cyclicality near term, it's not what fixes the problem. What fixes the problem is supply, is spending more money and having more supply. And we're not seeing that. We're simply not seeing metals and mining industry, nothing, right? I mean, nobody is spending money. Nobody is developing. The S&P Global put out a great research. I'm not sure if you saw this, but looking at industrial metals and even gold itself, and breaking it down into 2 parts of CapEx: development and sustaining. Sustaining to keep what you have, development to see what you're going to be building in the future. Mm-hmm. And guess what is shrinking over the years? Development. There is no new development of mines. We all know, I would suspect that most of the people here listening to this already know that it takes about 15 years to build a mine, right? To go from getting acquisition of a property, finding a discovery, which is extremely challenging, and then getting into the engineering phase and the financing phase of building a mine and actually start producing successfully. So, and that is a research that happened on the back of the last 15 years with low interest rates, low energy prices, you name it. Very globalized environment. What if we have a different world here? So I start thinking about these things and I'm like, well, does it really matter my view about interest rates in the next, month and what the Fed is going to do?
Mhm.
When most of these projects and companies and businesses are being sold like, with ultra, skepticism and inefficiency and you know lack of interest in capital interest, anybody that comes in with the right team and the right vision will probably be deploying some of the most intelligent, I think, capital we'll ever see. And so I think we're in a pivotal moment for a lot of investors that are able to take advantage of this scenario, because I don't think it stops here. I
Mhm.
think I think all these commodities go a lot higher, and there's room for lots of ways to skin the cat. Is it agricultural? Is it energy? Is it in a uranium space, or is it in gold? Is it silver? Is it copper, cobalt? Some people are in lithium, and always going to be the flavor of the day, but ultimately very few people understand these industries.
Mhm.
Everybody else only follows a trend, like few years ago it was all about lithium, all these new experts of lithium that didn't understand anything about it. And the truth is, why do I like mining? Just to tidy up my views, is that I know a handful of people that actually can put three sentences together about mining. That's why we're seeing that reflection on prices of those assets. And what an opportunity.
Mhm.
So that's my 2 cents on all this.
Tavi, there's so much to try and pick up on there, but I looked up what our gains in both gold and silver were so far this year. So gold is up approximately 30% since January, and silver's up approximately 35%. So just on a percentage basis, this seems like silver is kind of outperforming gold. But should we be looking at this from, as you said, more of a demand supply um, picture and perspective rather than just a percentage gain for the year?
Um, well, I one thing that I've been trying to learn in my career, and this is from reading incredibly smart people that have made billions of dollars, and hopefully I'm one of those guys one day. But um, my understanding is that you don't want to be too cute with markets and how they develop, because a lot of people would think about what you just said and say the silver market is broken. It's supposed to be up double that.
Mhm.
And it doesn't mean it's broken. It just means, you know, uh, markets have these types of sort of behavioral, changes over time. But if you take a step back and you kind of think about the long-term picture, if gold is going to be up, call it, in the realm of, 3,000, 5,000, it's highly unlikely that silver will stay here.
Mhm. Well,
It
that's
will,
sorry, just to interrupt for a sec, Tavi. That's why I specifically asked the question that way. If we just look at percentages, I personally feel that that is somewhat misleading, and
yeah,
we need more of a historical and a supply context to
yes.
truly understand what the potential is for these markets.
And to your point, I think there's some um, parts of this question that are quite unique to this environment today.
Mhm.
I don't think we've seen a time when, number one, lack of discoveries, um, the delayed of the trickle down of capital from the top miners into the very small ones. Um, the Also this underperformance of over 30 plus years of the mining industry relative um, to gold itself, which makes it really difficult for investors to justify deploying capital into mining.
Mhm.
But it's interesting though that a generalist will have that view that you just sort of posing that question, and the skepticism is certainly there. Like, why would I buy the mining industry, and gold itself is actually performing better than the mining space? Plus it's more liquid and less risk and blah blah blah. Historically, that's not necessarily what we tend to see when you have a bull market in the precious metals industry. The mining industry tends to perform incredibly well. It's needless to say that fundamentals tend to improve drastically, and they have leverage on both sides, negative and positive, right? So when things are going up a lot and people start really establishing themselves in this market, it doesn't take a lot of time for that capital to start flowing into those parts of those industries. And so I am of the view that this is happening as we speak. And it's interesting, as I said before, very few people understand this market well. And who understands it? The miners, the ones running those companies. And watch what they're paying for those assets being sold right now.
Mhm.
Watch those multiples of price relative to NAV that are starting to come into the picture more recently. Because one thing we know is that if there hasn't been any new discoveries, if you're running a mine, you're now really forced to, unless you're lucky to find a discovery, to actually have to buy other miners. And this is happening across, specifically in this industry. The oil and energy space is also seeing something similar, but I can speak with more confidence and have done a lot more analysis in the mining industry to share that with the public. And it is interesting that those multiples are rising within the industry. And what does that mean? Is that ultimately that also comes into the entire industry, but people are not seeing that as a potential just yet. Macro guys, majority of the big macro guys have basically given up. They look at the last 30 years trend and they're like, wow, that's it to me. There's a structural problem with this industry. I would suggest that the view here is that this industry is likely to become extremely critical for society. It has been, but the notion of the industry is that this is a money losing, space that, full of lies, with extreme mismanagement, um, and I think it's a huge black eye in this whole overall space, and I think that's not really a reflection of the opportunity for the next 10 years. And usually, as an investor, a value investor, you're always looking for sort of a legacy business, an industry that has been there for a very, very long time, and a business that is part of that industry that is trading at extremely low multiples, historically suppressed multiples, because of, as a reflection of the underperformance of the last, 2, 3 decades, and but has on the back of those historical low multiples a potential for entering a secular, bull market. And when you look at the underlying metal prices that appear to be in that position, given the supply and demand imbalance and the construction we're seeing, the onshoring, the deglobalization trends, and the green revolution, all sorts of things happening in that front, you would suspect that those multiples are, likely to be expended, quite significantly. And when you start expending multiples of things that have been basically dead for a long time and neglected for a very long time,
Mhm.
things can get really interesting. So this is, hence why I'm focused on that. And I think there's another part of the market that shows similar, characteristics would be emerging markets. They also present something very, very similar in my view.
Mhm. Well, to your point, Tavi, if we look at a ratio chart of gold versus the mining sector, it's a horrific chart that's basically at an absolute low, or let's say a relative low for the last at least decade, if not 20 years. Um, And as you guys recently wrote in Crescat's September research letter, if precious metals companies were a sector, they would have the highest cash flow margins in the S&P 500 index today. So, you know, do you really see this as an inflection point and, one of the best possible opportunities and entry points that we have seen? As you kind of said, we're at this point in time that the major undervaluation of these companies, it seems like there's a setup to have a recognition of this sector by the broader market because of this type of outperformance that you highlighted in the research lab.
I believe so. And I think that one of the also reasons is that it's just kind of a new thought, but when you're entering kind of a bubble environment where, everybody's excited about technology companies and new advancements and all sorts of things, and they start forgetting about profitability. They only focus on growth. Um, you kind of lack a little bit of the actual rationale and logic behind understanding and pricing a business. And the mining industry is one of the most complex, I think, industries out there, along with biotechnology, in my view. Biotechnology is also, a very specific ability to be able to understand that space. Very few people know how to do it. And the same goes to the mining industry. I can speak more to the mining space. And I think that is also a reflection of capital of interest. There's a trend of geologists declining secularly as well. And if you look at undergrads and graduate students willing to have a degree in this space, you can clearly see that there is a total lack of interest on that front. And all that is look, we're in the business of running mining companies, and it's extremely challenging even finding labor for that. And I've been operating a little bit more especially privately. And one thing I see that is very different in other industries is how much fat is you can cut, meaning not necessarily firing people, anything like that, but really trying to run it a lot more efficiently. It just seems like a lot of these companies have lacked love, caring, and attention, and that kind of laser focus on profitability. And for those that come with that vision, I think there's a lot of things that can be done: improving recovery rates, improving production, focusing on growth, which I think that it lacks in most of the major companies today, which are either divesting their assets or simply not focused on growth whatsoever. You look at some of the top companies in the space and you look at their production profile of gold or copper or minerals in general, it's been just a secular decline as well. And so I think that's all kind of tied up to this idea as well. And as cost of capital kind of establishes itself higher over the next decade, I think one of the impacts of that is looking for profitability. This industry, I will, repeat this, I'll say this, trying to emphasize this point, is extremely profitable at the right times. And, we saw that in the 70s, we saw that in the early 2000s. And I think we're entering another one of those. And my point of that chart was just to show one metric that a lot of people pay attention to, that is the case right now, that these companies are starting to deliver on the fundamental side. Now, I know very few industries that are being sold. Now, we are able to find assets today with some hair, that's normal, being sold for 1-2 times free cash flow. And, like I said, those suppressed multiples, if you're really entering a secular bull market, you're able to either fix those businesses or find, upside operationally on top of the leverage to metal prices, boy, I just can't think of many, multi-bagger potentials out there like this.
So, Tavi, when we think about these times of underinvestment in the industry, do you look at investing in the mining space more as an investment or a speculation? And should we be waiting for this, the tides to be turning towards the metal space um, because of opportunity cost of being invested in something that's not performing?
Yeah, I think that's a fair question. Although I think it comes down to your profile as an investor,
Mhm.
profile as a person. If you're a type of person who's got more of a short-term mentality to things, which is okay. There's, incredible traders and investors that have that mentality. That's one way. I'm a huge fan of a few investors. I'm a huge fan of, in particular, Senzel. He's one of the people I've tried to really think about when I invest. And he was a person who had a extreme knowledge about real estate, um, but also other industries. One of his capabilities was being able to enter new industries and exit industries at somewhat of a right time. It wasn't necessarily the perfect year and the perfect month, but he knew that an industry time was coming, and he would make that transition in 3 5 years very successfully. And so I try to replicate that. When people come to me and say, Todd, you've been wrong for 1 or 2 years on whatever thesis it is, as long as I feel confident with the thesis long term, that the idea is intact, and I am getting deeper and deeper into either deploying capital there and learning about the industry as much as I can. I think that's what matters, because when that wave starts, I feel like very few people have that niche ability to navigate the space. And, I want to be that guy,
Mhm.
one of them at least. And
Mhm.
I think there's going to be a few. Um, and I want to be that person who understands that market very well, for my own sake. And I think that's something that is going to be hard to replicate when things starts moving. When I think about my learning curve of the industry, which is, like I said, extremely complex, the amount of things I know today versus 3 years ago is, it's crazy. Not that I would have done a lot of different things, but I would say that the quality of things that we own today versus 3 years ago is yeah, it's important, it's relevant. And that rate of change of improvement is critical here, because anybody waiting for metal prices to, going back to your question, if you're trying to apply this strategy that I'm trying to apply, and you're saying, well, but let me wait for metal prices to turn first, and the mining industry really turn before I start investing. By the time that happened, you're done.
Mhm.
You're just not. Um, I'm not too worried about, paying a little bit more than I think. If I'm right and we're going to be buying multi-bagger potentials, if I lost one bag, one bagger, it doesn't really matter
Mhm.
at the end of the day. I just want to make sure that I have created a real network in this industry, and I've deployed capital in the highest quality assets I can find, and that I've created the right vehicles to surf the wave of this industry the most appropriate way possible.
Mhm. Yeah, it does seem like there's, as I said, the opportunity cost. There's also an opportunity cost to not learning enough about the industry and what what really makes for the possibility of a multi-bagger type of return, as you're saying. So let's turn a little bit to that, Tavi. How do you analyze miners, developers, explorers, um, and is there some common thread that you found, let's say, in each basket, that really shows potential to you in some of those companies?
I think that the exploration space is, you know, it is difficult and problematic, but it can be extremely rewarding. And I think we've done a great job hiding in that space. And then the main reason for that is expertise, working with the right people, Quinton Henney being the person that comes to mind, obviously. But also not worrying about as much about your losers, but focusing on your winners. I think people tend to look at us specifically and say, well, they invested in all these companies, didn't turn out to be anything. But if you get one winner, it basically pays off for everything. And that's where you need to focus on. It's playing that venture capital game
Mhm.
in the mining industry. And so we hear all these things, Tom. I'm sure you heard of, you got to focus on management, you got to focus on assets, you got to focus on this and that. It's a combination of things.
Mhm.
I've seen companies, I would say like Snowline Gold, for instance, just to give an example, which we have a position on, and we invested, pre-IPO, very well run company from the beginning, right? And things went very well. They found a major discovery. They had a big run. The stock was owned, by their family and the CEO and his family and ourselves and another few investors. No, and that created this this upward trajectory in the stock price that we probably don't usually see very often. So you can kind of the stage was set there for success. But that's very unique that you don't see a lot of these. We had other winners that wasn't necessarily the case. It wasn't a very tie cap structure, not the best management, and I'm not going to name names here because I don't think that's appropriate. But still, we had success on the back of those things, and so I don't think there's a formula to invest in exploration necessarily, outside of doing that your homework and making sure that you're paying the right price for the asset. And that there is a strong potential to become a scalable business, meaning that has the potential to become a big story, not a small one. Now, there is a problem with these things. Sometimes you get into some level of progress, not the same progress that we saw with Snowline. And unfortunately, um, you know, money is an issue as well. It kind of shows the best and the worst of a lot of people. And you tend to see, you know, egoistic decisions being made and problematic things that can completely destroy value of a company during that course of not yet succeeding but being in the process of doing so. And so that's been challenging. We've had a few situations like that in some of the stocks that we own, but that's just part of the activist role that you have to take. And I would say that on the more development and producing side, um, I find it interesting this especially institutional capital chasing. Institutional capital kind of leads board decisions because capital is basically the boss of those folks running those companies, and so they kind of lead their decisions at some point. And given their focus on copper and industrial metals, it has created a somewhat of a divergence of valuations of a few assets that are in the gold only space that are extremely valuable, but unfortunately, because it's not copper, or maybe not unfortunately is not the word, but because it's not copper, it doesn't have the same level of interest. And so it forces those companies to actually sell those assets. They call them tier two assets. And I view that as a great opportunity personally. So that's something I've been very focused on. And I think that if you're able to acquire some of those assets that are high quality, that are kind of part of this realm of lack of interest, um, are probably one of the best opportunities I've seen. And understanding maybe why there's lack of interest, especially in the bigger names and all that, is also a function of conservatism and how uh, think about this, right? You have this very complex industry and you have a bunch of generalists trying to understand. So there's a gap between the two. And that gap is formed by, forecasts of earnings and all sorts of things that all these analysts that supposedly understand these businesses are coming up with to try to help close that gap between the generalists that don't understand anything. And when you dive in a little further into those estimates and how they're projecting those fundamentals in the future, you start seeing some crazy stuff like consensus gold prices long term being 1800, right? And no kidding, the forecast for earnings for a certain company, whatever you want to call, any miner, will look depressed. And so if you're a general investor looking at this, you're like, oh my gosh, this looks awful. These guys are not going to make any money, and go, yeah, because they're basically almost sandbagging this, these supposedly good fundamentals that are likely to come in at gold prices that are spot prices right now. And because of the way they're, analyzed, or look at the resources of a lot of these companies, especially in the development space, and ask for, what's the gold price you're using to, in terms of sensitivity analysis of your resource or reserves. And you will see that a lot of those prices are still extremely low. And that's, there's a function, there's maybe an explanation to that from a cost standpoint that, should be pointed out. But I think this is a big part of, complex industries is you have to be able to close the gap, right? Generalist, complex, space. How do you close that gap? And that's what a financial analyst does, right? They try to present that to those guys. And I think they're doing a terrible job, personally. And it creates great opportunity, right? Because if the generalists are not seen and you can come in from another angle and say, no, I view this completely different than those guys. And I think there's a lot of ways we can create value here. And not to name one more thing, we bought a mine, large producer of silver, and before we bought it, we're supposed to be making, I don't know, like, supposedly $3 million on free cash flow in this mine. And that was the estimates from the seller and all that. This year, we've, the same year that it was supposed to be making $3 million on the back of a lot of efficient. No, this is not necessarily a metal price function. I'm talking about more efficiency issues. And, we're supposed to be making like, $200 million. Like, look at that delta, 3 million to $200 million on that. That's insane, right? I mean, that makes the asset go from almost an asset that is losing money to now a company that is highly profitable. So that was the opportunity. That was that gap between that I was referring to. So that's where I'm focused on. I'm trying to go to another, from another angle and understanding, what other people that are more generalist are not willing to go there. So I don't know.
Or what
That's
they're
one
missing.
thought. Yeah.
Tavi, for the average, generalist, as we're kind of speaking about, do you think that royalty and or streaming plays are an interesting place to be, or is their stability, their cost structure, and let's say the risk profile already really priced into a lot of those share prices?
Well, it's difficult because it's is that going to be your multi-bagger opportunity? Rarely, right? I think royalties have done a great job for investors in the last 2 to 3 years. And that is not to say they're not a great investment, but it's also, I think, it's not where the biggest returns are going to be in the following years. I find it interesting that companies like Franco that have been kind of in the leading edge of, obviously, of royalties have started to think about doing convertible debt and other things that, taking advantage of higher cost of capital. These are very smart operators and not operators, but investors in general, and capital deployers. And I find it interesting they're trying to innovate their own business by looking for those opportunities too. So I share that view, and you have to kind of evolve as an industry, and each segment of the industry will have will be the flavor of the year, or the flavor of the next 3 years or so, and those things change over time.
Mhm.
And I would say that royalties have definitely been on the top of that. And I think there's also, structurally speaking, they are part of the problem, in my view. A lot of the mining industries, the mining companies have sold royalties and have really damaged their profitability over the last few years. And I think that's a big function of some of the problem in terms of profitability of some of these companies today as well. So, and that's capital that is not going into exploration. That's capital that is not going into growth. That's capital that's not going into development, because it's going to royalty. And there you go. There you have, if you think about how much we've seen of structuring of royalties today versus what we had in the 70s, which wasn't even the case in terms of a concept. Think about that. Now think of the impact of that capital being redirected,
Mhm.
that should be going in the ground, but it's not. I don't know. It's something to consider. I think that only uh, I think it escalates the issue of development of new mines.
Mhm. Yeah, I find it interesting to really consider, as you kind of said, this turning wave back to mining, and really, let's say, rewarding it for the value that it presents, right? I mean, I know a couple months ago when the new president got voted in Mexico, she said that she was going to end open pit mining, I believe.
Mm.
And I saw a report the other day that that is now gone from her website. So, it seems like the tide is coming back to, maybe the best way to put it is coming back to reality on what is needed to move forward here. Um, and I guess the other part of the question I wanted to ask, which is something that you mentioned earlier, is, let's say, a 15-year lead time from discovery to, let's say, first shovels in the ground, or first production of a mine. Are there other jurisdictions that is shorter in, and are you looking at any of those, um, because of that possibility of a shorter, let's say, time to production?
Excellent questions. I think I'm going to answer the first one by using Charlie Munger's famous phase. Tell me the incentives, and I'll tell you the outcome. What was the
Mm-hmm.
incentive from uh, her perspective as a upcoming potential candidate to become the president? Her incentive was to get elected. She needed to have understanding that there's some left-leaning, popularity in that country. She needed to use those that type of narrative to get elected. As soon as she gets elected, what is her incentive? Well, her incentive now becomes, and this is not specific to her, it's specific to any president in South America, essentially. Okay.
Mm-hmm.
It's coming from a Brazilian. Their incentive now becomes to run the country successfully for the next 4 years, having no issues and all sorts of things. Obviously, there's other incentives, potentially corruption and all sorts of things. But ultimately, I think anybody would agree that they are not looking to have a major disruption in under their leadership, ideally. And when you realize first day in the office how much capital is coming from resources, you realize that you have to, immediately stop those policies, immediately stop that narrative, immediately change your tune. In fact, sometimes it's funny. I was talking to my parents about this yesterday, about this potential new development of oil in Brazil in the Amazon, and you know, and then saying that Lula was potentially as well shifting his view about allowing the development of those oil assets, despite the fact that could be seen as a problem environmentally speaking. It's actually it would be a lot easier to see Lula doing that because the left media would not criticize him than actually Bolsonaro, trying to say, let's develop this. Imagine the media on the left trying to basically murder him for doing that. So sometimes actually a left-leaning president may have more success approving these things than a right-leaning one, as soon as they understand that the exposure, economically speaking, is that they have to allow resource production to occur. So it doesn't surprise me to see that change in tune. I think that's very normal. There are situations throughout history that are more extreme, so not everything falls into what I just said. We have nationalization of mines in the past and other things that usually actually comes um, with a very steep rise of metal prices, which could happen. But how do you avoid that? Is making sure there's the cap structure of your mine or your project is established worldwide, and having, of course, a great relationship with the locals and great relationship with the government, but understanding that these things change very quickly. I would say that today, given the last decades, um, explains a lot about the premium and discounts inside of the industry. And my understanding is that there is still a premium in developed economies. There is still a premium in places like Canada and the US and others relative to other places. Let's just say use Africa, or especially South America is more of a bigger expertise for me. Not calling myself an expert, but it's something I cover more closely. And you can kind of see that there's a discount for those assets in South America. Now, markets change in terms of prioritizations, and I think the prioritization today has been jurisdiction, as you mentioned, but I think it's going to change towards how quick can you get something into production. We have a project in Bolivia privately that we found a discovery, and we think we can put that into production in maybe 5 years. And, you know, that speed would be unheard of in the US for a brand new project. And so should then Bolivia be, seen as a different jurisdiction when it comes to risk and how we like think about from an NPV standpoint. If you're accelerating that cash flow massively, what's the change of the valuation of the asset itself? It's insane. And, you know, put that into perspective, or Argentina, maybe Brazil, maybe Mexico and other places that understand the need and have a much bigger need to put something into production sooner rather than later. And imagine that becoming a priority in the next 5 to 10 years. Markets tend to do things that people view as impossible. And when I hear those words, that will never happen, that's impossible, I pay attention to that because I want to definitely stress test those ideas. And I think this is another one of those.
That's a great way to put it, is trying to stress test those ideas, Tavi. And I completely agree with you. I think the incentives end up really changing when we're running out of critical minerals or metals like copper, for example, lithium, gold, silver, all of these metals that we still do need to physically dig out of the ground to continue to make electronics, to continue to make electric cars, if the society keeps going that way. This is all stuff that needs to be approved and brought into production in hopefully a more efficient manner than it has been.
Yeah, and when I said the fat that you have in these businesses is that very few companies have this capability of spending 10, 20 million dollars to change something operationally that can deliver hundreds of million in free cash flow later on.
Mhm.
And that's the level of inefficiency I'm referring to is the lack of interest causes those potential changes you can make
Mhm.
that unfortunately, maybe I think actually fortunately should change that word quite drastically, but um, it's a reason why public markets have been seeing these companies so negatively.
Mhm.
And if you're running a private company in the mining space, things have been great. Of course, it's unique to each project and jurisdiction, all sorts of things, but things have not been bad. If you have access to that cash flow margin that I was referring to, imagine if you have access to that rather than just being a shareholder and seeing the multiples improving and so forth.
Mhm.
Wow. Now you can direct where that cash flow is going to go. We're going to buy another mine. We're going to buy back shares because I think everything's so cheap. You can do so many things with that access to that cash flowing vehicle now that is seen as a terrible business by 99% of the people. So yeah, I think it's Sam Zell again had a sentence that I think really stood out to me is he said great money is made where there's a true lack of capital
Mhm.
and not the other way around. And so applied that exercise with multiple industries. Does technology lack capital? No. So does it mean, that you're going to make multiples of your capital if you invest there? No, probably not. It's obviously a probability game. Doesn't mean you won't make a lot of money investing in technology potentially.
Mhm.
But if you're trying to kind of establish yourself playing that probability game, looking for those legacy businesses that are likely to become critical. I can see the narrative changing so quickly. If you have more wars going on, and Tom, just a point that is so important to me. One time I was looking at the fiscal, the capital spending relative to GDP privately in mining
Mhm.
all the way throughout history, going back to the 60s, used to be close to 20% of GDP. 20% of GDP was spent in mining. Do you know how much is spent today? Any thoughts? I mean, any guesses of how much that is? It
I'm going to
was
say
20.
I'm going to
Yeah,
say it's now less than 5%.
it is 0.3%. So two things. Yeah, there has been a lot of improvements. Maybe we don't need as much capital as we needed before. Maybe we don't need as much labor as we needed before. Although I would argue that the efficiency of mining from the 70s to today hasn't been like, a major shift. Of course, there
Mhm.
has been some changes, but not to that degree that would explain something going from 20% of GDP to 0.3. Now, what the change here is as well is that the US economy has become extremely dependent on imports of metals.
Mhm.
In the world that we're in today, where we need to develop things to onshoring and all sorts of other developments happening here in the US, I would think that that's kind of a big deal, along with other industries that potentially should be seen the same level of kind of critical aspect. But I would think that mining should be one of the top 10 industries that somebody should be paying close attention to and trying to secure supply for the next, call it 5 to 10 years at least. And
And
what if that's, yeah, go ahead.
I was going to say, and not just supply, but refining capability, right? If we don't have any refining capability for rare earth metals to
Yeah.
make permanent magnets, or any real tangible refining capability to produce uranium, and we're at odds with the countries that have this production capability. That's a real roadblock with as we were discussing before, real lengths of time before that ability to actually produce is solved.
So how can one expect that these policies towards helping these industries would logically make sense when very, very, very few people can put three sentences together about mining?
Mm-hmm.
It makes sense, right? I mean, but then that's the rate of change potential of improvement that we can see could be drastic.
Mm-hmm.
Partnerships. Think about countries that are very neutral that could be maybe playing a role into exporting more to the U.S. in this near-term situation, or places that have had incredible problems trying to develop a mine that may have a government support at some point to develop those you can kind of go there as assess your risk, but look, I mean, there could be some big changes in that front. I mean, how much does it cost to build a mine? It's a lot of money, not for the government. I mean, if they start spending a little bit of their capital into this, we can see some really big changes. A lot of projects that supposedly could not even be economic. I was just looking at First Solar, just as an example, a solar company. 90% of their operating profit comes from subsidies. 90%. Okay. I mean, what if that became a critical industry, right? For we can disagree that should not be seen as a critical industry, but it is seen as a critical industry, and therefore it gets subsidies from the government, from the Inflation Act. That makes zero sense to be called Inflation Act, to become the Inflation Reduction Act. So start thinking about this in the mining space. I mean, at some point, that capital is going to have to flow back to the mining industry, and that 0.3% of GDP needs to start going the other direction, and just to survive here, and make things less disruptive for economy. So I'll be surprised if that's not the case in 5 to 7 years.
Mm-hmm. Well, and I don't think it's necessarily only governments that have to finance projects like this, because it is a lot of capital expenditure that needs to happen. But again, the mining industry as a whole is such a small part. There's not a whole lot of private capital, if we can call non-government money private capital, that needs to come in that can make a massive difference in not only the production capability, but also the valuations of that sector.
Listen to Robert Freeland. The other day, he posted on Twitter, I guess. No, I'm sorry. He did an interview with someone. I thought it was extremely useful and similar thinking to my views. And he said, this whole idea of the financiers of these mines that we have in the US and developed economies using this approach of looking at mines from an NPV standpoint, right? So you're looking at discounted free cash flows of a mine, the potential of those discounted free cash flows to then, have a grounded view about the financial profile of that business, so you can then price the valuation accordingly and provide the capital for the buyer. Imagine you're just a debt provider and you're trying to think it with that kind of notion. Well, it's a competitive game because you're trying to buy a mine. There's other buyers. Some other people, and I'm referring to Chinese parties, are coming in and saying, forget about this NPV analysis. We're paying 3x that amount. We don't care. We just want to secure this. And you can't compete, right? So at what point do we see that becoming a narrative as well, right? At what point do we see the Western societies finally figuring out? It's the same thing that happened with our manufacturing capabilities, right? China basically did exactly that with the US from a manufacturing standpoint. and basically put a lot of people out of business. This is happening now with the mining industry, not just, in South American projects. You come in and you try to buy a project there. If there's a Chinese party involved, your chances have diminished quite significantly now to get that asset, unless you're going to really overpay for it, because they don't care what they're paying for. They will get that asset.
Because they recognize the value of the actual the asset and the metal, rather than and the need for that metal, rather than just the on book value, let's say, at the time.
As I told you before this discussion, privately, I was telling you that I'm in the process of buying a mine, hopefully. One of the biggest challenges we've had internally as we do due diligence in these projects and all these things is trying to get everybody to agree that we may need to overpay to get the asset, but it doesn't matter, because it's weird to say we're going to overpay for something for 50, 100 million. It's just a weird concept, but it doesn't matter. When you price things at gold prices that we may go, and I understand from a risk standpoint, you should be, trying to value this as low as possible and try to pay the right price. But think about this for, does it really matter if you're securing that asset and then you have this crazy upside, highly likely? That's what I'm here for. No, I'm not here for that amount. I'm here for, a multi bagger. And so you don't have to take the same approach as a Chinese party is capable of doing, because they have all this government-backed money. But why don't we have that here in the US, right? I mean, we don't have that yet. And I think we're going to go there. I think the first solar is example I use of 90% of the operating profits going towards, being from subsidies. We could see something along those lines in the mining industry at some point. I really think that that's a possibility.
Well, Tavi, I appreciate you walking us through your views on the sector, and I can certainly tell that you have a lot of enthusiasm for it right now. There's been times where we've talked where I can sense, let's say, less enthusiasm than I do right now, and that's exciting. And I think we need to get some refreshed energy into this sector, because it is, hopefully only a matter of time before it does get completely revalued.
Yeah, and I think what you said is right. It's lacking younger leadership as well. It's lacking new people. Like some of these companies, I know a company, I'm going to say it, I don't really care. Aura Minerals. Rodrigo is the CEO of the company. I have nothing with them. I don't have any shares that I own from the company, but it's a great example of a company that is being led by kind of a fresh new person with a whole new perspective, not a mining guy, who extremely smart, is able to kind of view this almost arbitrage of finding these opportunities as well, and investing for the long term. There are very few companies that have that type of vision. And again, it's a very, very complex industry, but those that have created that knowledge and allow themselves to also have that huge network effect of trying to build new things with that vision are going to, in my view, be extremely successful. And I think the dinosaurs of this industry are unlikely to actually to do very well. And I think every boat's going to be lifted, but some boats are going to be lifted in multiple ways and exponential ways, in my view. And that's where I'm trying to focus on right now.
Excellent, Tavi. So for those that are interested in any more of Tavi's work and the research letter that we kind of touched on, that's all available at crescat.net. And of course, excellent Twitter follow as well, at Tavi Costa, where you produce some excellent charts and really help people zoom out and understand the opportunity that's in front of us. Tavi, I really appreciate your time today, and we'll look forward to speaking with you in the near future here.
Thanks again, Tom. Really appreciate it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.